can. Will the United States always be the world's reserve currency? I suspect that until I die, yes. I suspect until my children die, yes. Do I think we'll be the reserve currency 1,000 years from now? I couldn't care. But for right now, we are. And that gives us the ability, maybe not the right, but it does give the United States the ability to run budget deficits that the rest of the world cannot. That's simply the harsh reality. That went over really well.
All right, I have one final question, and this sounds like a Simard question, but actually we got 2 or 3 questions from the floor that were largely similar to this one, and it is a tie-in to our host conference today, Horizons Beta Pro. In the past, investors seeking direct crude oil or natural gas price exposure have looked to names like Suncor, Canadian Oil Sands to get their desired commodity exposure. With the advent of highly liquid ETFs like the Horizons Beta Pro instruments, do you see more investors going this route to get their pure commodity price exposure? And if yes, does this mean that oil and gas producers should embrace commodity hedging in a more meaningful way to protect their cash flows and production growth profile if they are no longer the primary mechanism used by investors to gain commodity price exposure? And Dennis, maybe I'll start with you.
Man, I'm really confused by that question. I honestly, I don't understand the question.
There were 2 parts. Did you understand the first part?
Trying.
The first part, historically, investors had often used, if they got bullish crude oil, they would use a proxy investment like a Suncor or Canadian Oil Sands to take advantage of that bullish view.
Yes.
And now suddenly there's liquidity on these ETF products in commodities.
Yes.
So as an alternative, if today I get bullish on crude oil, what do I turn to? Do I turn to a producing company, or do I turn to the ETF to get that investment? And so I buy both.
Yeah, sure. Why would you not? There are plenty of times when you're going to turn to the ETF because you might think that it is, for whatever methodologies that you use, you might deem that ETF to be cheap relative to producers. There will be times when you wish to own a producer. There will be times when you wish to own a crude futures contract. There will be times when you'd rather own Brent than WTI. That's the beauty of what we have now, is that there are so many different venues that you can choose from, that you can make valuation decisions as to which one is the better. There have been times over the course of the past 5 years, people always knew me when I was bullish on crude oil several years ago, and I would talk to people and I would always say Suncor. That was always, when I wanted to be bullish of crude oil, I bought Suncor. There was a time beginning last year, after July and August, that I didn't want to own any Suncor any longer. And there were times when I wanted to be short of crude oil futures. So the fact that we have different venues doesn't preclude me from using any of them. In fact, I applaud the fact that we have more venues. It gives me spreading capabilities. I can buy one, sell the other. I can find out one that is relatively cheap relative to the other. So I think the question begs an answer that really needn't be given. The answer is, I can use any of them.
Well, I think you're looking at 2 different things. When you buy the commodity, you're talking about WTI. When you're talking about the stock, you're not just talking about WTI, you're talking about something that is correlated with WTI but is independent, and that is, what kind of earnings multiple are you going to see in that? And more specifically, particularly for the folks in this room and particularly for this oil patch, what kind of takeover multiple are you going to get? You know, when Shell took out its Canadian subsidiary, I believe that was a 40 to 45% premium to the market. And that pretty well is par for the course on any major energy takeout on global capital markets, or it was before oil prices plummeted. So what you get with the Suncor or the XEG or whatever the exchange traded fund is, what you get is, you know, the real extra octane. And the real extra octane is that you get the multiple expansion, and if you hit the bullseye, you not just get the multiple expansion, you get the takeover premium, which is probably 40% above where the multiple expansion took you. This is what you lose, okay, or you give up. You own the stocks, and the TARP program, you know, goes down the drain. It doesn't matter what happens to WTI. I mean, the energy sector is 30% of the TSX. So if you were to buy, you know, an exchange traded fund like, I don't know, the Barclays XIC or whatever that owns the TSX. Okay.
That's the wrong one.
Okay, or whatever. The fact of the matter is, guess what? You're selling Suncor because 30% of that is the energy sector. Whether you make a conscious decision or not, when people go, I want to get out of the TSX and I'm not going to do what Dennis does and buy strips and get my ass blown off, but I will go into cash, okay? When I do that, realize that you may not have made a conscious decision to sell 30% energy stocks, but you've just done that. So that's the trade-off. I mean, on one, you're talking just about the commodity. On the other, you're talking about the added juice that comes with the commodity. Now, they're not totally independent because obviously you don't get a whole lot of M&A activity when oil is $10 a barrel, or it's the kind of M&A activity you don't want to see, okay? I mean, the two things go together, but there are two different roles here. When you buy the exchange-traded fund from whatever organization, you got to realize that you're taking on systemic market risk that may have nothing to do with the sector you're buying, and particularly in the case of energy where you're talking about 30% of the TSX. So you got to have a view not just on oil, you also got to have a view on the TSX.